With world-class expertise and local insight, Dexus creates value, not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, welcome to the COB this Friday afternoon as we continue to see the market sell-off exacerbate. I'm Juliette Sarli. Not great news to bring you, and of course not only what we're seeing in the overall markets and the hits to our superannuation accounts, but there's been that cyber attack to super too. So not a great day of news. Let's see where we are finishing the session. Down 2.3% there on the CBO 200. The ASX 200 has re-entered correction, down some 2.4%. Tariffs very much spurring this selling frenzy. You've seen the likes of CBA, Macquarie, tech players hit. Very few areas really spared today. Where we are seeing momentum is in the bond market as traders really start to price in more rate cuts amid the turbulence that we are seeing. So that really brings us to our themes of the day and what a week it has been. I think we're down something like 3.7% on the ASX 200 over the week. So that is our worst week since 2022. Now, our producer Marius is French, so he's given us a different way of saying what a week, and that is semaine sanglante. I hope I got that right. Oui, oui, parfait, he says. And of course, that is awful week in French. May, of course, now live in terms of what we are expecting from the RBA to counter the effects of the turmoil we're seeing in financial markets. ANZ saying you could actually see a 50 basis point cut in May. HSBC also among those bringing forward their rate cuts. And when you look at the implications on the bond market, certainly pricing in now that we will get a full percentage cut throughout 2025, 102 basis points factored in fact, according to money markets. And that's up from something like 75 basis points only a couple of days ago. Remember, amidst this big week we've had, the RBA actually met on Tuesday, leaving rates on hold. So, of course, what next? We've got the key jobs data in the US. We've got the Fed minutes next week. We've got readings on consumer sentiment, the RBNZ expected to cut too, and we just continue to watch the fallout in financial markets. Let's have a look at the sector moves today on our market, I should say. Kicking it off with energy, because this was the other huge story, of course, that OPEC Plus moved ahead with its output cuts, really sending a lot of weakness through the energy space. Woodside also out with a sustainability report today. It fell by 9%, as did Santos. Tech players hit hard as well. We saw the likes of NextDC in particular and WiseTech, look at that, down 9.3%. Zip also falling by as much as 14% today. Consumer staples, though, looking very defensive in this environment. A great conversation I had with John Lockton from Sandstone Insights. You can find that on the website. Coles, Woolies on his defensive pick. Don't forget, we still have to eat amidst this environment. Perhaps we still have to drink too, and I certainly think a lot of people are feeling that way after the week we've had. Endeavour Group there is up by almost 3%. Interestingly, though, of course, we're still seeing the impact to these agricultural related stocks. Elders, A2 Milk coming under pressure today. In terms of the corporate news, well, we heard from Woodside with their sustainability report. CEO Meg O'Neill saying it's too expensive for them to make deep cuts to their carbon emissions. Of course, the oil prices slump, though, really factoring in there. BHP, according to Reuters, considering separating its iron ore and coal activities from its main listings. Telix Pharmaceuticals was also in the news, appointing Ann Whitaker as non-executive director based in the US. And Automotive, one of these companies that has been hit amid the tariffs. We should point out Ansell, Breville Group as well. Let's flip the page and have a look at what we've seen with Vulcan Energy, saying it could benefit from China's restrictions on lithium technologies. It claims it's one of the few Western companies with a similar offering of the lithium extraction technology, ADLE. And Mesoblast confirming its allergenic cell therapy products will be exempted from tariffs, still down 4.3%. All right, let's get his take, and welcome to the COB, our Friday guest, Shane Oliver from AMP. Always good to see you, Shane. Loved your note today. Perhaps not Liberation Day, but Retro Day is what we're facing.
Well, that's what I think it is. I think it's backward looking, that Trump is not going to return to a golden age because that's impossible. But it is retro in the sense that his administration dreams of going back to the distant past when everyone drove a Chevy or a Cadi or played with hula hoops in the 1950s. But yeah, Americans have often dreamt this, but it's not going to be possible. I don't think it's realistic in any way, shape or form. But the highlight of the week is that chart that's just flashed up there, which shows US average tariffs as a share of imports, and they're heading back to where they were, well, probably above where they were in the 1930s. In fact, heading back to where they were in the early 1900s. So that's allowing for all the tariffs that had previously been announced: steel, aluminium, autos, China, Canada, Mexico, and then of course adding in the ones that were announced on Wednesday or Thursday morning our time. So that's, I think, a major problem. I mean, we've had decades of progress towards globalization and free trade being reversed in a flash, just the stroke of a pen, as Donald Trump likes to do with those flourishes, all for a pile of nonsense. If you try and go through the logic behind his reciprocal tariffs, it's completely nonsensical. But we are where we are, and this, of course, is causing a lot of volatility in markets.
Absolutely. And what it is seeing is people fly to safety. So also looking very closely at what's happening with gold amidst the market turmoil.
That's right. Gold is proving to be a good safe haven here, as are bonds. Bond yields have come down. Quite clearly, the market is more worried about the hit to growth than the boost to inflation. And we've seen central banks, or expectations regarding central bank rate hikes, escalated. When I was looking at major countries, we'd expectations for rate cuts this year are either up 25 basis points or at least 15 basis points. Money market in Australia is now looking through, I think, 4 more rate cuts this year in Australia, and it's a similar story in the US, and that's also driving bond yields down, providing that safe haven status and providing a bit of an offset to the weakness we're seeing in share markets for investors. But as you can see there, money markets are looking for significant further cuts ahead in Australia, the US and other major countries around the world. Europe, I think, is particularly well placed with some good inflation numbers out this week. But of course, gold's gone to a record high. It's proving itself as a good safe haven, unlike the US dollar, which normally goes up in times of uncertainty. You can see in the chart there, the gold price zooming off. The US dollar was strong, but it's almost reversed all of the gains since Trump was elected. I think, in fact, all of the gains since Trump was elected, and looks likely to have more downside. It almost looks as if investors are reconsidering this so-called concept of US or American exceptionalism, that they can ride through things because they've got a better economy. And Donald Trump is causing that reconsideration. Investors, including in Australia, thinking, well, should we really have 75% of our global equity allocation to the US, which is current or has been the benchmark mix in global shares? So that's obviously causing a rethink there. And I think it's partly because of his inclination. There was good things in some of Donald Trump's agenda. The tax cuts, you could argue, the deregulation, or at least good things from an investment market point of view. I'm not saying necessarily socially. But some of his policies did look almost like they were inspired by Ronald Reagan. Markets initially celebrated that, but lately he's just pivoted towards the negative and very dark, I think, policies, whether it's regarding geopolitical issues with Ukraine and so on, or whether it's in relation to tariffs and this retro look, which I think will just set the American and the global economy back. But gold is proving to be a good safe haven. Bitcoin so far just seems to be moving around with the share markets. It went up when shares go up and it comes down when they're coming down. So that's still a bit of a concern regarding Bitcoin. Interestingly, though, this weakness we're seeing in the US dollar does make it a bit harder for countries like Australia, because normally when you have shocks like this, the Aussie dollar would go down, providing a buffer. Now you're not seeing that. The Aussie dollar has been relatively stable around the 62, 63 level. It did have that earlier fall from September, but it's almost as if the market's saying, well, we don't want the US, maybe Australia's a better bet than America is. Mm-hmm. And that, of course, means that there's more pressure on the RBA to respond. If the Aussie dollar hangs up around these levels or doesn't see much downside despite the supply shock or the shock to global growth, then that could mean more pressure on the RBA, which I think it ultimately will do.
Yeah, you're going to sort of wonder what Trump's end game is, to your point too.
You do.
Have you sort of changed your view? Have you brought forward your rate cut view, or what's your thoughts now?
Well, to be honest with you, after the meeting on Tuesday, we were quite comfortable that we're on track for a cut in May. That is the next meeting. I don't think, unless there's a complete meltdown in markets, the RBA will move ahead of that. Can't rule that out, though, but I think that's unlikely. I think we will get that cut in May. Our view was predicated on the view that inflation will come down. And the commentary we got from Michelle Bullock on Tuesday seemed to be less hawkish or more dovish, depending on which way you want to look at it. She didn't push back against market expectations for more rate cuts than was the case in February at the press conference that you were at. That to me I think is also a positive sign. But of course, since then we've seen this escalation of the tariffs. And of course, the RBA statement and Michelle Bullock implied the same thing, that if there were to be an escalation or a widening in scope of the tariffs, then that could be a threat to economic growth. And that's what we've seen. So I think, yes, we will get that cut in May. I'm more confident about that now, just like the money market was 75% probability. Now it's in excess of 100% probability. We were thinking another cut after that in August. And then one more in February. You'd have to say now there's a good chance we might get another one or two on top of that. In other words, 3 or 4 more rate cuts by year end. In other words, the tariffs and the turmoil that's been driven by them just brings forward the cuts and probably adds to them. So that could turn out to be the silver lining on the Trump dump cloud, if you want to see it that way, for homeowners with a mortgage.
Yeah, absolutely.
Lower interest rates.
Yes, the only potential silver lining, at least for what we can see at the moment.
And
me. Amidst all the Trump noise, and he does love to dominate the news cycle, Shane, it's sort of been forgotten a little bit that we're in the middle of an election campaign. How did you view the kicking off of the campaign, and I guess what next as we head down to May 3rd?
Well, it's interesting in a way. We have seen that. Early in the new year, everything was going the coalition's way. Now it seems to reverse to some degree. So it looks sort of 50-50 in terms of two-party preferred polling. But that raises the likelihood of minority government. It's hard, I think, for the coalition to get the 22 seats they need to get a majority. But it looks like Labor will lose some seats. They probably get the best chance of forming government. Long way to go, though. But, if it's with the Greens, then it's going to be more of a leftist government. If it's with the Teals, say, that they don't lose so many seats that they have to go with the Greens and can go with the Teals, then you can get something which is more centrist and might be a bit more sensible. But obviously, it all makes it harder for serious economic reforms in Australia. And so far, a lot of the policies that have been announced by both sides have been like Band-Aid solutions, whether it's the mini tax cuts, the electricity rebates continuing, the lower drug prices, the excise cut reduction from the coalition, those sorts of things, or reducing the interest rate serviceability test from 3% to 2.5% under the coalition. All of these things, I think, are Band-Aid solutions. They're not really addressing the fundamental problems. You could argue the coalition is a little bit closer to it with its commitments to reducing red tape and arguably moving towards smaller government, providing it's not done the same way as the fruitcakes in the US like Musk and co. We just go through with a chainsaw. But that seems to be heading in the right direction. But overall, we're not seeing any big reforms being promised. Maybe it's too much to ask for in an election campaign. But obviously, in this environment, we need to be strengthening our economy, and anything we can do to get productivity up to help in the tougher economic environment we're coming into with Trump's tariffs and geopolitical threats, I think would be welcome. And hopefully we'll see that after the election. But so far, it's a bit hard to get too excited on that front because you don't see a lot of it.
Yeah, absolutely. All right. Well, I actually do have a hula hoop. I got one through the pandemic, Shane. So I'll head back to 1950s, use that over the weekend. But what a ride. Cool. We'll see you again next Friday. Thank you. Shane Oliver from AMP. All right. The stock of the day, Ansell, Kai Chen from MPC Markets, Mark Morland from Value 3 joined Andrew on the call.
it's fairly inelastic in terms of the products that they produce. You know, it's protection gear, medical protection. It's things that you need. So I think this demand is fairly inelastic and it will still be there. So they're just going to take the price increase.
And if you look at their earnings, they peaked in 2021 at $2.54 a share. In the last report, they were $1.17. So, and that has been a slow, steady decline since 21, which was their high. And the return on equity is now 6%, return on capital 4%. These are all really, really poor numbers. So there's nothing in that before we even talk about tariffs that would make me want to hold answer. I wouldn't buy it and I wouldn't hold it. As far as I'm concerned, it's a losing business.
All right, as we mentioned, we have re-entered correction territory on the ASX 200 on a big day of selling. But let's have a look at the leaders, if there were any. Coles, we mentioned there, and Woolies being quite defensive, along with the likes of Endeavour Group. Sonic Healthcare also had a good day, and Capricorn Metals was up 5.5%. To the downside, though, plenty of those. We mentioned the likes of Emotive, Breville, the impact of the tariffs on their companies and whether or not they're going to be able to absorb them. Zip, Alcoa, Karoon Energy also coming under pressure. In the small end of town, having a look at, the Brisbane Broncos. Is that the football team? I'm not aware of that stock. Excuse my ignorance. Never wrong for long. I'll find out later what it does. Xanadu Mines up 10%. Lynch there up 5.3%. And to the downside, we had Blue Bet off by 15.5%, Terramin, Centera, OneView Healthcare and Australian Vanadium all falling today. Tonight, it's hard to believe that normally this would be the focus of our show on the COB, the non-farm payrolls, looking ahead to that. But certainly the President and the tariffs have taken centre stage, but we will be looking at what the jobs market in the US did in March. And of course, a speech from Jay Powell. And is the Fed going to potentially save the day? Certainly a lot of expectations. Maybe there will be more and faster cuts given what the world is currently dealing with the tariff fallout. Looking ahead to next week, we've got Westpac Consumer Confidence for April, the NAB Business Survey. Confidence expected to be below the long-run average. Michelle Bullock, the Governor, speaking on Wednesday, getting US CPI on March. And Friday, we get, of course, that overseas arrival and departure migration data locally. Let's see where the local market has finished the day's session, and certainly on the lows they're down 2.3%. On the ASX 200, as we mentioned, we are in correction territory, so down 10% from the peak that we saw in March, down 2.4% on the close, 192 points, 7,667, a new 100-day low. And I'll just get you the fall over the course of the week, down 3.9%, so almost 4% over the week, so the worst week for the local market since 2022. Sorry to leave you on that not positive news, but I hope you have a safe and happy weekend. We'll see you from 9:45 a.m. Eastern on Monday.